Welcome to the Sloth Investor podcast with your host, Mr. Sloth.
The information on this podcast is provided for education and informational purposes only. The information contained in or provided from or through this podcast is not intended to be and does not constitute advice of any kind. Welcome everyone to episode 11 of the Sloth Investor podcast, an investing podcast that explores why I believe the humble sloth is the best animal to characterize successful investing. Once again, I'm joined by my fellow Sloth investor and co-host Jay. Jay, how are you?
I'm doing fabulous. And a little bit of a fun fact for our audience out there. This is our, as you mentioned, our 11th episode. And actually my hockey jersey number happens to be number 11. So I feel really good about today's episode.
I love that. I had no idea, Jay. Number 11 was your hockey jersey number.
You got to come and watch me play some hockey.
Absolutely. I have to, Jay. I really will have to. Brilliant. So it's our 11th podcast today. And, the topic would perhaps have been more fitting as a topic for episode 1. And that's because today we answered a simple question. Why should you invest? So across our various episodes so far, we've referenced this question in various ways. But I thought it would benefit our listeners to have us devote an entire episode to this very important topic, to synthesize our thinking with regards to this question into one tightly knit podcast episode.
And actually, it's a really interesting point because I have people in my life who I don't need to invest or it's not that important. And my hope is that maybe one day they'll tune into a podcast like this that helps them understand why the importance of investing for their own future. Now, we're movie fans, and you've made plenty of references to movies throughout our podcast. And I also know that you're an Alfred Hitchcock fan. Now, I think there's some parallels to be drawn between the silent thief of the money world and that, quite simply, none of us can escape from it. Would you like to tell us a little bit about a movie that you're thinking about, that you have in mind, and more importantly, tell us about why this silent thief that, quite frankly, it affects us all?
Yeah, Jay, so I was watching a Hitchcock movie recently, and I couldn't help but draw a parallel to the realm of investing. Okay, so the movie that I was watching was To Catch a Thief, and it was directed by Alfred Hitchcock in 1955, and it starred Grace Kelly and Cary Grant.
Going way back.
Way back here. Oh, yeah. Over 65 years ago, okay? And, it says something about Mr. Sloth that even when trying to unwind with a movie, I can't help but think about the realm of investing, okay? So, To Catch a Thief was an entertaining movie, but I like to turn our attention to the silent thief that we must all take steps to overcome. And that silent thief is, of course, inflation. Inflation. I love it, Jay. Thank you. I'm loving that sound effect. So if you're someone that's committed to saving money, then that's fantastic. However, if saving money forms the cornerstone of your financial philosophy, then you're likely losing money. This is because a financial philosophy that is purely defined by the sole intention of saving money will not enable you to tackle the ugly reality of inflation. Inflation is the silent thief of the money world, and you must take steps to combat its effects.
Now, for our audience, we're going to need to break down this word inflation. Really, you hear the word all the time thrown around, inflationary pressure, and we've got to watch inflation. And what is inflation? People need to know, what is inflation?
It's a great question, Jay. And you're right. We hear it in so many different contexts, on news bulletins, within the financial media. So let's take a little bit of time now to break it down. So inflation is the rate at which the prices of goods and services in the economy are increasing, which reduces the purchasing power of your money. Inflation is a natural part of the growth of an economy. Quite simply, as the demand for goods and services increases, so do prices. A little bit of inflation is healthy, but too much inflation can rapidly diminish your standard of living. The rate of inflation will affect the real interest that you receive from your bank savings account. For example, if you receive 2.5% on your bank savings account and inflation is 2.5%, then the interest rate that you have actually received on your savings is 0%. Therefore, before you begin to give yourself a congratulatory backslap because of the amount that you have saved, you must understand that saving alone will often not be enough to beat or even keep pace with inflation. Taking the next step to ensure that your savings are invested properly and generating significant growth is critical. Quite simply, if you're not investing, you're likely losing money over the long term due to the effects of inflation. Jay, do you have any thoughts about inflation, or perhaps even why just saving money is most probably not enough for a significant number of people?
And you know what? Another fun fact here: my son's friend Luke is actually a Sloth Investor podcast listener.
I like it.
So huge shout out to Luke if you're listening to this episode. And I'm trying to think about how could I break it down to our listeners who are like Luke. And inflation is cost going up.
Yeah.
And on average, we see inflation of what 3 to 4% a year?
Yeah.
So you're going to want your investments to be greater than 3 to 4% a year if you intend to actually make money. Is that correct? Is that fair to say?
Absolutely. You got it, Jay. You've got it. Yeah. And, something we've touched on before is life expectancy. And
how does that impact your investment strategy? So when you live longer, your money has to go further.
Of course. And the interesting thing is that around the world, life expectancy is continuing to increase. And that's great. You know, we want to be able to live longer lives, to see more of our family and so on, enjoy longer lives. But there's a problem though, because in terms of financing that longer life, it's something that is a real issue. And it's something that we really, really want to address now. So, Jay, when you dig a little deeper into the stats on life expectancy, you know, they really, truly are fascinating. So while recently perusing the Our World in Data website, I read that since 1900, the global average life expectancy has more than doubled and is now above 70 years old. Okay, so that's a global average.
Globally, around the world.
Globally, global average around the world. And Jay, interestingly, we happen to live in the location in the world that has the highest life expectancy in the world. And that is, of course, Hong Kong.
Hong Kong. So how does this affect your investment strategy? What does this do? Knowing that you're going to live longer in Hong Kong, how old are we going to live to be on average?
I mean, these stats are amazing for Hong Kong. The average life expectancy for females in Hong Kong is 87.8 years, and it's 82 for males. Hong Kong is followed by Japan in second place. In Japan, there is a life expectancy of about 87.7 years for females and 81.5 years for males. This data has been taken from worldpopulationreview.com. Jay, what are your thoughts on this first prize accolade for Hong Kong?
Well, you know, I got to admit, I was actually surprised at first when I saw those stats for Hong Kong. I would have thought there's some environmental factors that would impact our life expectancy here in Hong Kong. But then I thought about my wife and me, and I could see a variety of reasons why she's probably going to live a lot longer than I will.
You know, something I speak to family and friends about. And one thing that's always struck me about Hong Kong is just the commitment to keeping fit, moving your body, leisure time. I mean, when I'm walking to work, if I'm out and about on the weekend and I'm seeing, the elderly population, some people doing Tai Chi and generally moving their bodies in a great way. And that's something I really admire about this region of the world, is that there is that commitment to looking after your body, to keeping fit, moving your limbs. It's something that I really admire. So yeah, I think for me, that's another key reason.
And you go to the parks around Hong Kong and you'll see like there's the machines in there that are intended to keep people mobile, like arms activities or little simple machines to move your arms up and down or move your legs, just to keep yourself mobile. Interesting stat.
It really is. It really is. So when considering life expectancy, I like to once again mention a book that's entitled The 100-Year Life, Living and Working in an Age of Longevity by Andrew Scott and Linda Gratton. So I referred to this book during one of the previous episodes, but it's worth mentioning again for the purpose of today's episode, and also for the fact that it's one of the most illuminating books that I have read within the last few years, as it explores the inevitable decisions that will have to be taken as a consequence of humans living increasingly longer lives. I think it's critically important that we recognize and indeed are ready to take advantage of the simple reality that human beings are living longer. If you plan to retire at the traditional age of 65, then this means that you need to factor in a possible 30 plus years of retirement, perhaps even longer if you happen to be the beneficiary of advantageous genes or you are fortunate to reap the rewards of continuing advances in medicine. Okay, so this means that there will be a tremendous amount of bills to pay for, and if you intend to enjoy an active retirement, defined perhaps by travel and other leisure pursuits, then you'll need to plan accordingly. Therefore, it's vital to ensure that you have enough money to finance your retirement. Quite simply, the earlier you begin investing in a stock market, the greater opportunity that you will have to finance the retirement that you deserve.
I think back to, I think governments around the world, it's fair to say, are recognizing and tuning into the fact that people are living longer and they're extending the mandatory retirement age. I know that's happened here where I work, that they've just recently extended the mandatory retirement age for people.
That's right, yeah.
Now, you're a father, I'm a father. How does investment relate to us having children? Where's the connection? Is there any connection?
Yeah, it's a great question, Jay. So investing for my children's future is a key reason why I invest. And I know that you're the same. In fact, with the Olympics finishing just last month, let me throw in another sporting analogy. Okay, that was the theme for episode 8 of our podcast. And I love analogies. It's a simple fact that investing is a way in which you can pass the baton on to the next generation in your family. Or you could say it's a way of making a deposit for the future. So I want to smooth my children's passage through life. It is my hope that the wealth that I generate can help to reduce the financial burden of the respective paths that they choose to take within their lives. So this could be, the availability of funds for things such as college tuition fees, a car, or perhaps even a deposit for a house further down the line. So on that first point, tuition fees, invariably from time to time, I'll read in the media about the increasing cost of education for young people and how many are becoming saddled with high levels of debt. However, investing in an appropriate manner can alleviate or perhaps even altogether eradicate this financial burden. By choosing to invest, you can potentially generate enough wealth to ensure that your child will not leave university saddled with debt. Now, Warren Buffett, arguably the world's most famous investor, neatly encapsulates the beauty underpinning this transference of wealth when he states, "Someone sitting in the shade today because someone planted a tree a long time ago." And that is one of my favorite investment quotes. It's such a beautiful quote and it resonates so deeply with me, particularly as a father. And Jay, I want to ask you, would you add anything on investing as a key way to smooth your children's journey through life?
Yeah, I think about myself as my own parents and being their son. And if I understand correctly, wealth, quite often, the American dream of becoming a self-made millionaire is very unlikely. But wealth, my understanding is inherited, largely inherited. And for me, my parents have busted their buns and worked very, very hard and made sure they invested properly and so that I will be taken care of in the event of something happens to them. Similarly, for me, if something should happen to me unexpected and that I want to make sure my children are provided for and taken care of, should I not be around to do that. And it's not just about old age and retirement for me, but it's also making sure that my children are set up to be in a good position to assist themselves. You talked about education. I want to make sure that they can take care of themselves and money is not as a big a worry for them as it has been for my family and generations previously.
Great points, yeah.
I want to be self-sufficient when I get older as well. So I don't want to be a burden to them. I want to make sure that I can take care of myself and then they can focus on taking care of themselves and building their own investment strategy and portfolio.
Many great points. I love that, Jay. Thank you. So, and you touched upon this a bit as well, but another reason why I believe it's important to invest is that it broadens one's life choices. So yes, we've just spoken about the positive effects for our children, but let's also remember that investing can enhance our own life choices. So for example, perhaps at some point in your career, you decide that you would like to take a break from work, whether this be for a year or perhaps even several years. Investing can undoubtedly facilitate and help to actualize such a decision. Of course, there's a whole movement known as FIRE that believes in the ability of investing to ensure early retirement. That acronym FIRE stands for Financial Independence, Retire Early. It could also be that an individual has a business idea and they could use some of their investment funds to help to finance this idea. Jay, do you have anything to add here on how investing can function as a choice enabler?
Yes. I know people talk about early retirement. For me, I'm focused on two things. Making sure that I can afford, my wife and I love to treat ourselves to reflexology. We're big fans of reflexology, so we want to make sure that we can, we're in a position that we can continue to enjoy reflexology and it not being a concern for us. But also, Hong Kong is such an eat-out culture. That's an important aspect to who we are and our social interactions with people. And also, we do like to travel. We like to visit places, and I want to make sure that I can continue to have that same kind of lifestyle as we get older. And the investment for us is an important part of that, making sure that we can continue to live, whether it be the reflexology, whether it be the dining out with friends and not having to worry about the cost of it, or we want to go visit a new place and making sure that we can do that.
And something that really became apparent to me as you listed those three, the reflexology, eating out with friends and family, and the travel opportunities, all three of them are experiences, and somewhere down the line, I think we could have an entire episode devoted to money, maybe money 101, for example. But it's fascinating because I've read plenty of research about experiences versus things. I know Andrew Hallam, author of The Millionaire Teacher, we reference frequently on the show, he's also spoken about the fact that human beings, they tend to derive more happiness and satisfaction from experiences rather than things. So all three of those, what you mentioned, are prime examples of experiences. So I think it's great that you mentioned those.
We have I have those discussions with my kids that this is, we might not live in the biggest flat, or we might not have the newest car, but making sure that we have these family experiences together. That's where a lot of our our disposable income goes to, is making sure that family experiences are sort of top of our list.
I love that, Jay. Yeah, something that my family can also resonate with as well. It's brilliant. So another reason why I believe that it's important to invest is quite simply the historical data that demonstrates the long-term returns of investing in the stock market. So despite a hysteria sometimes associated with this method of wealth creation, the hyperbole and neon lights that we see on news bulletins, the undeniable fact is that over a long time horizon, the stock market moves upwards. According to Jeremy Siegel, Wharton Business School professor, the average annualized return for the US stock market between 1802 and 2012 was 8.1%. Moreover, applying the data from more recent history, we can learn that the average rate of return for the US stock market from 1946 to 2012 was 10.5%. And listeners, this data was taken from Siegel's book, Stocks for the Long Run, the 5th edition, published in 2014. So depending upon your source, whether it be online, in a book, or word of mouth, the most often commonly quoted historical return for the stock market is generally in the range of 7 to 10%. If you want your money to overcome the harmful effects of inflation, that silent thief that we spoke about, then you should be aiming for an average annual return in this range. The purpose of the Sloth Investor's 5 bedrock principles is to outline a rational, common sense, sloth-like strategy that you can implement to fulfill this objective. Jay, any thoughts on the long-term historical returns that I've just shared?
Yeah, and you know what, we've mentioned it. We've made mention of it before. Now, I was just trying to call up the article. Andrew Hallam just released an article on his website about how the best investors are the people who don't follow. Bottom line is, the less you follow the markets, the better your investments are going to perform. And if you can ignore the noise, you're going to be able to benefit not only from the long-term growth of a stock market, but also the compounding interest, which is another important aspect of your investments, making sure that you don't neglect that. And I know we've touched on that previously in the past.
And it's funny, I'm just thinking, we're facing each other now and we're both wearing a set of headphones. And I think really for investors, what would be 2 items I would recommend for them to kind of wear? I would say, adorn a set of headphones and also wear a blindfold. Okay, those 2 things are going to help you to block out the noise, the sensationalism that we spoke about so many times within this podcast, but really just tune out the noise, remain invested, ignore the hyperbole, and inactivities to order the day. That's a key principle of the Sloth Investor.
And you know what? We all make mistakes.
Yeah.
And just last month, I made one, and I read a headline that scared me, made me nervous. And I thought, you know what? I'm going to divest from this stock that has made headlines. And sure enough, true to form, that stock has rebounded 35% higher than when I sold it. Yeah. And had I just ignored the noise and just sat it out and waited out and been patient, I wouldn't have. I interpret that as a loss, a missed opportunity.
Sure. So Jay, I want to focus upon now one of the final reasons why I think it's so important to invest. And that's because, quite simply, it's never been easier to. So there is now an abundance of information available to the 21st century investor. So as a young man, my father and many other members of his generation were not fortunate enough to have access to the same degree of information that I now have access to. Therefore, listeners of the Sloth Investor podcast should be grateful and consider themselves lucky that the information age that they live in has radically improved the opportunities that they now have to invest. Again, as it's worth reiterating, these opportunities were not so accessible to previous generations. The internet has significantly contributed to the democratization of information over the last 20 to 30 years, and this certainly includes investing-related information. And, of course, the Sloth Investor podcast would probably not have been possible were it not for the frictionless advances in technology that we've seen in recent decades. Jay, you're a seasoned, experienced user of tech on a day-to-day basis. Have you also been impressed by how much easier it's become to invest in recent years and how technology has helped to facilitate this?
Actually, it's quite remarkable, the change. When I first started investing and I wanted to make a change, I had to go through another person. So I'd have to call up that person, say, I want to do this. They would send me a form. I'd have to sign the form, send it back to them, and then the trade or the transaction could happen. And this has some good points to it because you're less likely to make a trade. But also, along with this, you mentioned the word frictionless. What has been a positive byproduct is that fees tend to have gone down dramatically. I was paying quite a bit in fees to go through a broker, and with the digitalization of companies like Interactive Brokers, who I personally use, but also Robinhood now has made access to trading and for investment frictionless. It's made it simple and easy and accessible, and you can do it on your phone. But there's also a darker side to that you are more likely to make a trade, perhaps, if you're not sort of a little more wise to the game.
Yeah, definitely a double-edged sword, like you say. On the one hand, it's great that you can, invest in a company, within 30 seconds and invest in a globally diversified ETF and so on. But on the other hand, like you just mentioned, Jay, there can be that tendency to check too often, perhaps even on a daily basis, how your stocks are doing. So yeah, certainly, shades of gray we need to, factor in there when we think about that frictionless world in which we live in, double-edged sword. Okay, Jay, so, we're coming towards the end of the episode, but I want to talk about an episode that's coming up soon, but let's touch upon it a little bit now because it really does link in well to today's theme, which is, why invest? So we're soon going to commit an entire episode to investing in a sustainable manner. The fact that we can invest our money in a way that aligns with our own ethical principles, whether this is in relation to the environment or perhaps even the treatment of people. So I think many people underestimate the extent to which they can use their income for a greater good. That is, to invest their money in causes that they are passionate about and fundamentally believe in. So again, in an upcoming episode, which I penciled in for October, we're going to explore this much deeper. However, Jay, would you like to briefly add any of your own insights on this?
Yeah, one of the things I would tell people, and yeah, I think you gave me this term maybe last year, invest in the world where you want to live. And for me, this has meant I have divested from some banks, which I had some ethical issues with, but also from big oil, and put that into things more sustainable, like renewables. And I've sort of transferred out of one sector and industry into another, which I feel is where I want my kids, the kind of world I want my kids to be living in.
Yeah, I love that. I think it's so important to consider our investments in that way. So, Jay, to close today's episode, I would like to state a final reason for investing, and it's that your success as an investor can undoubtedly exert a positive compounding effect upon other people. So this could be family members, friends, co-workers, and even complete strangers, okay? So talking to other people about the fruits of your investing success will likely cause a ripple effect. Taking myself as an example, I first became interested in investing after talking to my father-in-law, who was kind enough to share the wisdom that he had acquired within the field of investing. In addition, listening to Andrew Hallam, author of several investing books, including The Millionaire Teacher and Millionaire Expert, has enabled me to learn more about the positive traits required to become a successful investor. So as you become a more knowledgeable investor, a more seasoned investor, I encourage you to, in a sense, pay it forward and pass on the actionable wisdom that you take from this podcast and from other sources. So Jay, any thoughts on this idea of paying it forward or of helping others along with their investment journey?
And paying it forward is exactly what it's about. I know when I found out that I was in a bad investment scheme, I leaned on some people who said, you're in a bad situation, you need to get out of this. There was of no benefit to them, but they helped me, guide me to a place where I'm a much more better position to set myself up for the future. And for particularly my one friend, Ronnie, he changed things around for me and my family. He helped me understand what I needed to do to help my own self and get me out of that situation. And I know what's happened for me is I've tried to pay that forward by doing things like I run some information sessions here for my colleagues and try to help them understand the basics and avoid the same pitfalls that I've fallen into, but also the reason for this podcast.
Yeah, absolutely.
We have no affiliates. We have no people that are paying, no sponsors. Nobody is paying any money, but we do this purely because we want to help people understand the benefits to their own selves, but also avoid some of the mistakes that people like me have made.
Yeah, absolutely. Okay. Paying it forward. So Jay, I think that wraps up today's episode. Your hockey shirt jersey number 11. 11. I like it, Jay. I like it.
All right, everybody. Thanks for tuning in, and we will see you in our next episode, episode 12. Take care.
Take care, everyone. Bye-bye.
For more tips, follow the Sloth Investor on Twitter at @Sloth_Investor.